Hi there. Capital gains tax on property sales can be huge, but some UK landlords can legally reduce the bill using business asset disposal relief. PTA explains who qualifies.
Imagine this. You open a letter in 2026, and it's a tax bill for £180,000. Now, for many UK landlords, that's not just some scary story. It's a very real possibility. But what if there was a way you could legally slice that bill down? Well, today, with some fantastic guidance from the expert tax advisors at ProTax Accountant, we're going to break down a critical, really time-sensitive strategy that could save you an absolute fortune. Let's get right into it. Right, let's just let that number sink in for a second. £180,000. That isn't just a figure plucked out of thin air. It's the potential tax you could be looking at on a £1 million property gain if you sell in the 2026 tax year. It's a shocking amount for sure, and it really sets the stage for a closing window of opportunity that we absolutely need to talk about right now. So where's all this coming from? Now, there's a major tax storm brewing on the horizon, and it's aimed squarely at UK landlords and business owners. You see, a unique combination of rule changes is creating a pretty serious financial threat for anyone who's thinking about selling their business assets in the next couple of years. Okay, so what's happening is basically two big things at once. First, the government is getting rid of the furnished holiday let regime, which has been a huge help to many landlords. And at the same time, the tax rate on a crucial relief called business asset disposal relief is going up, and not just once, but twice. This combo creates a real ticking clock for anyone wanting to sell and save a huge chunk on their tax bill. Now, to really get a grip on this opportunity, we first need to understand what some people call the 10% dream. This was a reality for a lot of people, all thanks to something called Business Asset Disposal Relief, or BADR for short. You might actually remember it by its old name, which was Entrepreneurs Relief. So what is this BADR thing anyway? Well, in a nutshell, it's a type of relief on your capital gains tax that massively cuts the rate you pay when you sell business assets that qualify. The whole point of it was to encourage people to invest in and grow their businesses, by giving them a reward when they eventually sold up. And with a lifetime limit of £1 million in gains, it is incredibly valuable. Okay, this next bit is absolutely key to understanding the whole thing. A standard buy-to-let property is just seen as an investment, right? So it gets taxed at the higher capital gains rates of 18 or 24%. But a furnished holiday let, or an FHL, was treated completely differently. HMRC saw it as a trade, and that little distinction was like a golden ticket for FHL owners because it gave them a route to that super low 10% BDR tax rate. But now, well, the rules have changed. Landlords are facing a double whammy that completely flips the script. And understanding these changes is vital if you want to see the opportunity that is genuinely about to close for good. So, from April 2025, the entire furnished holiday let system is being scrapped, gone. And the knock-on effects are huge. Your FHL will now be treated just like any other rental property. This means no more automatic path to BADR, and a load of other really important benefits, like full mortgage interest relief and capital allowances, are also disappearing. It's a massive shift. And this is where it gets really, really time-sensitive. You'll want to hear this part. Just look at this timeline. Right now, before April 2025, the badge rate is at its lowest, 10%. Then, on April 6, 2025, you get hit twice. The FHL rules are gone, and the badge rate jumps to 14%. Then wait another year and it jumps again to 18%. The window to do something is closing and the cost of doing nothing is going up fast. Let's make this simple with an example. Let's say this is David. He's selling his holiday cottage and he's made £1 million gain. Just look at these numbers. If he sells this year, his bill is £100,000. If he waits until next year, that jumps to £140,000. And if he puts it off until after April 2026, boom, it's £180,000. This shows you in black and white the real-world cost of delay. And without the special rules we're about to cover, he'd be facing a massive $240,000 bill. It all sounds pretty bleak, doesn't it? But here's where it gets interesting. Here's the strategy. The government's own rules for winding down the FHL system have, well, almost accidentally, created a time-sensitive 3-year window of opportunity. So the big question on everyone's mind is, with the FHL rules disappearing, is it just too late to get those lower tax rates? And the answer, if you act decisively, is no. But you have to follow a very specific set of steps. Right, here's the crucial point. The tax rules say that when a business stops trading, you have 3 years from that date to sell the assets and still claim BADR. Because the entire FHL system is ending, you can formally cease your FHL trade on or before the 5th of April 2025. As long as you met all the qualifying conditions before that date, you then trigger a 3-year window to sell the property and still get the relief. This is the absolute key to this whole strategy. So how does this work in practice? Well, the rate you actually pay depends on when you complete the sale inside that 3-year window. If you sell before April 2025, you lock in that lovely 10% rate. If you sell in the 25-26 tax year, you'll pay 14%. And if you sell in the 26-27 tax year, it's 18%. So the strategy gives you flexibility, but the clock is definitely still ticking if you want to pay the lowest possible tax. Now, as you can probably imagine, this isn't some simple, straightforward loophole. There are several really complex traps you need to be aware of. And this is where a lot of people get caught out. So it's vital you know about the pitfalls that could completely wreck your claim. Okay, first and foremost, you have to genuinely, properly cease the business. This quote from HMRC guidance couldn't be clearer. Just because the FHL rules are ending, that doesn't mean your business has automatically stopped. You have to formally stop all your letting activity with no intention of starting again. It's an active, irreversible step you have to take. And there are other traps too. HMRC has what they call anti-forestalling rules. They're basically designed to stop people using artificial contracts just to lock in a lower tax rate. Then, if your holiday let is inside a company that also holds other investments, you could fail the substantial non-trading test. You also must have owned the business for at least 2 years. And this is a big one. This strategy only works if you stop your entire FHL business, not just selling one property out of a portfolio.
Let's just have a quick look at that non-trading test because it catches a lot of people out. HMRC basically has a rule of thumb. If more than 20% of your company's activities are non-trading stuff, like holding investments, then the whole company could be disqualified from BADR. You're looking at things like turnover, assets, even how management time is spent. It can be a very fine line to walk.
So, with all that in mind, what on earth is your action plan? What do you actually need to do before this window of opportunity slams shut for good? Here's a pro tip, and honestly, it's probably the most important thing we'll cover. You need to review your entire business structure and how you own your assets, and you need to do it now. The sheer complexity of all these overlapping rules, from the cessation dates to the anti-forestalling stuff, it just means that trying to go it alone is incredibly risky. Tailored, professional advice isn't just a nice to have, it's absolutely essential. Which brings us to the final question. And this one is really for you to think about. Your situation is completely unique to you. So have you actually taken the time to calculate what these changes are going to cost you? And more importantly, do you have a clear plan in place to act before these deadlines come and go? And of course, we have to be really clear about this. This information is for general guidance only. Tax law is complicated, it changes all the time, and this is absolutely not a substitute for professional advice that is tailored to your specific circumstances. To get that expert, tailored advice, you really should contact the team at Pro Tax Accountant directly. All their details are on your screen right now. They can help you build a personalized plan to navigate all of these complex changes. And for more valuable updates just like this one, make sure you subscribe to their YouTube channel. Thank you so much for watching. I really hope you found this breakdown valuable.